You're a global entrepreneur. You want to hire people around the world. You want to travel the globe while you run your business. What is the best entity to do that? Let's take a closer look. Hi, my name is Javier Correa. I'm a research and development associate here at Nomad Capitalist, where we help 7- and 8-figure entrepreneurs, investors, and freelancers go where they're treated best. And we also help their companies go where they're treated best. So obviously, one of the main things that clients come to us for is offshore company incorporation. And so often we get questions like, what is the best place to incorporate an offshore entity to run a business or to protect assets or to hold investments? And in all cases, the answer is it depends. So in this video, I'm going to dive in and I'm going to describe different types of entities that might be useful for different types of entrepreneurs in different types of situations. Now, do take into consideration that each entrepreneur's individual situation might be very unique, and by no means are the examples that I'm going to give in this video all the available options. They are just some of the most common options that we see work often for global entrepreneurs. So the first type of entity I want to talk about is the pass-through entity. So if you're listening to this and you're watching this video from the United States, you might be familiar with the nature of the US LLC that is a pass-through entity for tax purposes. Well, the US LLC is one of the best examples of this type of entity, but it's not the only one. You also find LLCs in the Cook Islands, Nevis, that are also pass-through entities, as well as in European countries such as the United Kingdom of Great Britain and Northern Ireland that has the famous UK LLPs, limited liability partnerships, that are also pass-through entities. So what are the benefits of running a business through a pass-through entity? A pass-through entity, by definition, is transparent for tax purposes, meaning that the entity itself does not have to pay tax at the corporate level. It may have to file informational returns. It may have to file taxes in terms of showing the distributions to each member, but then each individual member or shareholder or partner, depending on the type of entity, will have to pay tax on the income allocated to him or her at the individual level. Now, the benefit of this is that it gives you the flexibility of only having to worry about where you live personally. You always have to consider the quadrant. Where my business is, where it is incorporated, is important, but where I live is also important, right? If I have a tax-free company, but I live in a high-tax country that has terrible CFC rules or that just over-regulates, then maybe the fact that the company is tax-free is not really helping me that much. In the case of pass-through entities, they make your life simple in the sense where the entity itself is not taxed, and then you have the freedom to move basically around the world. Pass-through entities can be very useful, especially if you plan to relocate to a tax haven, like for example, the Bahamas. We've talked about the Bahamas in previous videos. Feel free to check those out. The Cayman Islands is also a tremendous example. So if you live in a country that has simply zero tax and that does not levy any type of tax on income, capital gains, or business income of any kind, then a pass-through entity might make a lot of sense. In addition to that, if you live in a country that does not recognize pass-through taxation, that it will still treat your tax transparent entity as a corporation for tax purposes, that may create a situation whereby you can retain earnings in the company and might also be very favorable. So just globally speaking, in summary, pass-through entities are useful provided that you yourself are relocating to a tax-free or tax-friendly country, and also that the work of the business is being performed in countries that are tax-free or tax-friendly. Keep in mind that if you as the member or partner of a tax-free or tax-transparent entity live in a tax-friendly country, that's great, but if you have a staff of people sitting in Miami, Florida, or in London, England, or in any other high-tax jurisdiction that you can think of, then essentially your income will still be taxed as it is sourced in a country that is high tax. In the case of active income, you always have to keep in mind that generally that is sourced where the work is performed. In the case of passive income, like for example, interest, royalties, dividends, that's usually taxed in the jurisdiction where the payor is located. What are the top choices when it comes to pass-through entities? You have US limited liability companies, United Kingdom limited liability partnerships. Those would be basically the main ones located in more whitelisted jurisdictions. And then you also have jurisdictions like Nevis or the Cook Islands that also have limited liability companies that work on a pass-through taxation system. In addition to pass-through entities, you also have companies that can be registered in territorial tax countries. And here, countries like Panama may come to mind, also territories like Hong Kong, and potentially city-states like Singapore. Now, each territorial tax country has its own nuances, and it's important to always consult with a tax professional in each one of those individual countries, as they may define territoriality slightly differently one from the other. But in a nutshell, the benefit of a territorial tax system is that by definition, those countries only tax income that is sourced in their own countries. Meaning that if you have a Hong Kong entity or if you have a Panama entity, you may be able to basically earn corporate profits tax-free, provided that none of the work is performed in the jurisdiction of incorporation and that you're able to successfully show that all of the income was earned offshore. So for example, Hong Kong is one of the main jurisdictions that is used in this kind of context. Hong Kong is obviously one of the world's main financial centers. You have great banking in Hong Kong and in other places around the world that may accept a Hong Kong company, like for example, Singapore, although it has become slightly more difficult in recent years. And so the process in Hong Kong, for example, is the following. The Hong Kong tax authorities will audit you every year. They want to see and they want to verify whether this income is actually sourced offshore, and you as the owner and director of the company have to proactively request what is called an offshore profits claim in order to make sure that the income received in the company may be fully exempt from taxation in Hong Kong. Now, obviously, as Hong Kong is a territorial tax system, this means that you cannot have offices in Hong Kong, you cannot have anyone performing any work duties from Hong Kong. You as the director of the company and shareholder of the company should limit your time in Hong Kong. But if you follow specific rules and if you file the proper paperwork, it may be possible to use a territorial tax country or territory like Hong Kong to basically earn tax-free profits at the business level while you travel the world. And if you employ people in countries that are, again, either tax-friendly, tax-free, then you may operate a fully tax-free business. Now, one of the main benefits of also incorporating in a place like Hong Kong is that they do not levy any tax on dividends. So let's say you're a global entrepreneur and you have your business in Hong Kong, you can simply successfully retain profits in the company tax-free, and then you can take out dividends also tax-free, at least on the Hong Kong side. If you also match a Hong Kong company with a friendly tax residence, like the ones I've described before, then you can make sure that you are completely free on the dividend side as well. Keep in mind that this is different from the previous example of pass-through entities, as pass-through entities technically don't issue dividends, they just allocate capital, and you have to report those on your personal tax return regardless of whether you take a capital distribution or not. Some of our clients ask about Singapore. Singapore is also an interesting jurisdiction from a tax perspective when it comes to territoriality. However, Singapore has a much more nuanced approach where, for example, remitting funds to Singapore might trigger a taxable event in Singapore. So one of the main benefits of having a Singapore entity, which might be potentially banking in Singapore, is unfortunately not available if you want to operate tax-free. In addition to territorial tax countries and their companies, you may also find countries that have special exemptions or special provisions in their laws that basically exempt specific forms of income. And the main example I can think of in this category is Switzerland. So Switzerland, we've talked a lot about Switzerland on this channel, mainly, within the scope of the lump sum tax options that you may find in Switzerland, which make Switzerland very advantageous from a personal standpoint. But what most people are not aware of is that Switzerland can also be a very interesting place to incorporate a company. Now, Switzerland is not a cheap jurisdiction. It is for entrepreneurs that have greater capital. It is for entrepreneurs that are looking for that prestige of having the Swiss brand behind their company. So in Switzerland, you can either form a Société Anonyme, so a corporation, an SA, or you can form a Société à Responsabilité Limitée, so the equivalent of an LLC, the Swiss abbreviated as an SARL. So basically, in the case of a Swiss corporation, you have to put up 100,000 Swiss francs worth of capital, whereas in the case of a Swiss LLC, you have to put up 20,000 Swiss francs worth of capital. So as you can see, in either case, we are talking about a considerable amount. Obviously, if you're in the seven figures, then 100,000 or 20,000 is a small amount, but still it's a larger amount of capital than you would have to contribute to form a company in other jurisdictions in Europe or North America. So Switzerland on paper has a worldwide taxation system, and it does tax income regardless of where it's sourced. However, there is an interesting provision in Swiss law that allows companies to basically earn income tax-free, provided that the income has been earned through a foreign permanent establishment. What does this mean? If I have a Swiss company and I've established an office overseas, and this office is where the company operates, where all the employees are located, or all the work is performed, then any income attributable to that permanent establishment may be tax-free in Switzerland. And the other important thing that is important to mention is that in the case of Switzerland, there is no minimum tax requirement for those permanent establishments, meaning that, let's say under an extreme scenario, you could form a Swiss company and then have a permanent establishment in a tax haven, like for example, the Bahamas or the Cayman Islands, and still be able to claim that that income is tax-free in Switzerland. Swiss companies do have to pay a sort of corporate wealth tax that is usually very low, between 0 and around 1%. You can say it's basically a maintenance fee for the prestige and the ability to have a company in Switzerland. In addition to that, even though the income does not have to pay income tax in Switzerland, you do have to report that income to Swiss authorities. So you do have to fill out a tax form every year and report that income. Furthermore, you do need to have a nominee director in Switzerland, and there are many Swiss law firms that can provide this kind of service. In addition to that, you also have to be mindful of how you take capital out of your company. So Switzerland does apply withholding taxes on dividends, unlike Singapore and Hong Kong. However, this can be lowered through a tax treaty depending on the jurisdiction where you live. For example, if you are a tax resident, non-domiciled resident of Ireland, Malta, Italy, this might be an interesting solution for you. And also note that Switzerland has a very open network of tax treaties that includes countries that sometimes do not have tax treaties with everyone, like for example, the United Arab Emirates. So there are ways to basically lower those withholding taxes on dividends, potentially down to 15, 10, 5%. In some cases, if you own the Swiss company through another company, then you may have a withholding tax of 0. It all depends on the individual circumstances. It is also possible to potentially derive a salary tax-free from your Swiss company. Another country that recently joined this group would be the United Arab Emirates. Now, up until recently, the United Arab Emirates would have been included in the group of traditional tax havens, simply 0 tax all around. However, as most of you are probably aware, the United Arab Emirates introduced a 9% corporate tax recently, which means it is no longer completely tax-free. However, it is still very tax-friendly when it comes to corporations and companies in general. So what do I mean by this? Well, number one, the United Arab Emirates exempts the first $100,000 or so in income from taxation, meaning that if you run a small business or if you run multiple businesses and you want a tax-free subsidiary, provided that your income and your profits remain at that $100,000 level, then you can still benefit from the 0 tax condition in the UAE. In addition to that, the United Arab Emirates also exempts certain activities. So for example, on our main channel, you may have seen Mr. Henderson's video where he talks about UAE companies. He goes into a great detail. I'm just going to mention 1 or 2 elements that might be interesting. So number 1 is, for example, if you are operating a company and you're providing some kind of a treasury service, so for related parties, that may still be fully tax exempt. So again, if you run multiple companies and you want to provide services to related companies and it falls within treasury services, then that can still be taxed at 0%, provided that you're a free zone company. And in addition to that, holding companies also benefit from a 0 tax regime. If you incorporate a company in a Dubai free zone and it's used to hold securities or to hold subsidiaries, then in that case, it still is tax-free. The other important thing to note there is that the United Arab Emirates remains fully tax-free on the personal side, so any dividends that you take out of your company are also not subject to tax. Then the last, basically big category, which is unfortunately a category that is dying out, is the pure zero tax company. So you still find those in places that are essentially small islands. So you will find those in places like the British Virgin Islands, like the Bahamas, like the Cayman Islands. If you go to the Pacific, you've got, Marshall Islands. All of these places are essentially zero tax. Now, the thing with these companies is that it is becoming increasingly difficult to use them for operational business purposes. Now, if you're a freelancer, maybe setting up a BVI company might still make sense. You can access mid-level banking with decent amounts of money. You may be able to access very high quality banking with, at least a six-figure deposit, or, in some cases, maybe they'll require a seven-figure depending on your nationality. So if you're just a freelancer providing services to specific clients and you already have basically a list of clients that knows you very well, you may still be able to operate through a company like a Bahamas company, a BVI company, Cayman Islands company. However, in general, for active businesses, it's not something that will make operations easier. Therefore, generally speaking, zero tax companies like the ones I just described are best suited as personal holding companies. Like if you want to open a brokerage account, or if you want wealth management account at a bank that is mostly, that caters mostly towards wealth management clients, then that can still be okay. And it can be simple. It can provide privacy, confidentiality, asset protection to a certain extent, and it can also allow you to hold your investments. So having said all of this, thank you for watching. If you want to learn more about offshore entities, asset protection, privacy, potential tax-free companies, subscribe to our YouTube channel, follow us on Instagram to know how we can help you go where you're treated best.